don't be depressed or frustrated seeing 62 PowerPoint slides for a 1 hour or 1.5 hour lecture. So there are two ways. One is that while I continue with my talk, you can raise your hand and ask your question, okay? If you're too shy to raise your hand and ask question to me directly, then you can note down your question and email it to Professor Charumati. We'll later email it to me and I can respond to you. There's no problem in that. Or else, if you do not want to bother me during the lecture, at the end of the lecture, we'll get some question and answer session for a few minutes. That is when you can also ask your question. Okay, so today's topic, we are going to cover 3 more standards today. Section 26, Section 27, Section 28 of IFRS for SMEs standards. These are share-based payments, impairment of assets, employee benefits, okay? Out of these 3, as it is small and medium enterprise, probably share-based payment is not that crucial. At the same time, employee benefit is not that crucial, but impairment of assets is really crucial topic, which is really important. As I said to you last week, that why do we use standards? Main thing is that if we all follow these standards, these measurement requirements, disclosure requirements, then there will be a uniformity between and among all these financial statements. And as a user, we will be able to compare the performance of these entities. And that is the main purpose of the standard. Remember though, standards are legally binding if any country adopt them through passing some kind of regulations in the parliament. But standards got flexibilities. They always say something that you can do this or you can do that, or you can do something within this, something like that. So as a manager or as a owner, you'll have always opportunity to show bit of your creativity to present your financial statements. When I say creativity in a positive sense, creativity not in negative sense, that creative financial accounting that we heard about it. Again, these standards are closely related with accounting treatments. I know that you're not accounting students, so we'll not be emphasizing on accounting, recording, and those kind of things, okay? You only need to know how these are actually measured, how they are recognized, how they're reported, those kind of things, and a little bit of calculations, not the accounting journal entries or recording, just the calculation part, which you have learned in your high school. And I'm sure that you can cope with that. Okay.
Professor, with your permission, it is being recorded.
That's fine. That's fine. Okay. So our first topic is share-based payment. Okay. So you are a owner of a small and medium type entity, or you are working there, and your entity has got publicly available shares, okay, and you want to use the shares for making payments, okay. This standard deals with, in that situation, how we are going to measure these transactions, how we're going to report these transactions, how we're going to recognize these transactions, okay. So this is share-based payments. Now, there are 2 types of share-based payments. One is called equity share-based payments, and the other is called cash-settled share-based payments, okay? 2 types. And these 2 types have got slightly different measurement, slightly different recognition, and slightly different reporting standards. So that's why I need to distinguish between equity-settled share-based payments and cash-settled share-based payments. So by the way, of course, you are aware of it. What is a share? Share, if you own a share of a company, of course, you're one of the owners of that company. If you own a share of a small and medium entities, of course, you're one of the owners of that entity. And share may have got 2 values. One is the value, which is called book value, the value at which the share actually was originally issued, okay? And the share may have a market value, and which always differ depending on the performance of the entity or the business. Okay, so in what situation we're going to apply equity settled share-based payments? It is very simple. I mean, if an entity receives goods, okay, as a consideration, goods or services as consideration for equity settlement. So an entity receives goods or services and says that in exchange for that goods and service, the service provider or the seller of the goods will receive share from the company, or maybe debenture from the company, or something like that. That is equity settled share transaction. Okay, it is mostly shares that have been actually provided in settlement. And what is the cash-based payment transactions? It is slightly different. It is something like that an entity acquires goods or service, okay? Acquire goods or service, and which is need to be paid in cash at a later date, depending on the value of the share of the entity. So there's a slight difference. One is that you are getting goods and services as a consideration, and you're paying by share immediately, equity shares. And the other one is that you are getting goods and services, okay, but you saying that, okay, it will be settled by cash, and the cash will be equivalent to the value of the share of the entity at a later date. And the second one, equity-based share payment, is mainly related to employee service contracts, okay, mainly, most of the cases. And they also attached with share appreciation rights. What is a share appreciation right? Share appreciation right is that if your business says that, okay, if you, one of your employees that if you serve for 2 years, in 2 years' time, you will be getting a share of our entity, okay, provided that the price of the share is $30 at the time. And the employee will have the right to decline to receive the share if the share price is $10 at the time, okay? So that is called share appreciation right. I mean, employees will have a right to accept or decline depending on the price on a particular date. Okay, so shares, share-based payments have got two types. One is equity settled share-based payment. One is cash settled share-based payment. Equity settled is that you are paying by share immediately, and cash settled is that you'll be paying by cash at a later date. It may be immediately, but most of the cases at a later date based on the value of the share of an entity on that particular date, okay? So the next question is that when you recognize, I mean, we need to recognize the transaction to be reported in the financial statement. So when is the right time to recognize a share-based payment transaction, and what we're supposed to do in our accounting records? This is very, very crucial, very, very important, okay? We recognize when goods and services are actually acquired, okay? So goods and services actually received in our premises as a small entity, and we pay by share immediately. And at that point, the transaction is recognized to be recorded, okay? Or if you enter into a contract with an employee that if you serve for 2 years, at the end of 2 years, you'll be getting something like 100 shares, provided that the share prices are $30 each in 2 years' time. Once you enter into contract, which means that now you're liable to pay to your employee, and that needs to be recognized in your financial statement as a liability. Okay, so if you pay by a share, of course, your entity's total equity value will increase because you are increasing share numbers, okay? Okay, and if you remember, when you pay by share, you're not buying share from the market and then paying, right? You are issuing new shares to pay. And that's why the equity of the total equity of your entity will increase. All right. And if you lock into contract with your employee that you'll pay in 2 years' time after an employee completes his or her surveys, all right. So you also have to create a liability, payable type liability, and that should be shown as a liability in the balance sheet. So that is a criteria that at what point share-based transaction is to be recognized, and at the same time, how you're going to treat them in our financial statement of financial report. That is what you say. Okay, let's take an example. Think carefully, all right? Although the solution is in the next page, don't go for that, okay? So this is not rocket science calculations. You should be okay, all right? So a contractor has been appointed to complete alterations to buildings owned by Bangkok. They have used city name anyway. The contract price is fixed at $2.2 million. After completion of specific milestones, the work is certified by independent controllers. On receipt of a certificate, 50% of the amount certified is payable in cash. Okay? So stop here, calculate. You are smart. All right? 2.2 million. 50% of 2.2 million is 1.1 million to be paid by cash immediately. Okay. And the balance by issuing shares. Remember I said that when company pay by share, they issue new shares. They do not buy their own share from the market and pay. No. Balance by issuing shares at their market value to settle the remaining 50% balance. So remaining $1.1 million will be paid by issuing shares. Okay. The shares have nominal value of $5, which I said at the beginning of the lecture. We also call them book value, but nominal value is the real accounting term. This is the value, this is the price at which shares were originally issued by this company. On March 31, 21, Bangkok received a certificate of $2.2 million. So independent valuer certified, the work has been completed. Okay. When the fair value of the share was $40. Okay. The number of shares to be issued is 27,500. Okay. How they calculate it? So 50% of 2.2 million will be paid by cash. 1.1 million will be paid by share. Okay. If the share price is $40 now, so 27,500 shares to be issued. All right. But there's a little bit trick in accounting record. The question asks provide journal entry. I actually said here that we do not want you to learn journal entries. We want you to just learn how the calculation is done. Okay. So there's a little bit catch in accounting term, accounting record. We always record the equity portion based on the nominal value of the share. That is the real share price. Okay. At the difference, 40 minus 5, $35, we call them in accounting share premium. Some of you have probably seen that or bought share in the market, probably noticed that. Okay. So share premium is also an equity, but our standard says that share premium and the nominal value share to be recorded separately. So that's why when they provide journal entry, you see that. So the asset is actually $2.2 million, the construction value, and cash paid $1.1 million, and the rest 50%, $1.1 million, $5 for 27,500 shares is the real equity, share equity, the nominal value, and the difference is actually share premium, which is also equity, but standard says that they have to be shown separately. So this is simple calculation. That is the way the calculation is done. The main thing is that we learned here that how share-based payment is used by an entity. Okay, so most of the cases when there is a share-based payment are involved, there are vesting conditions. Okay, so equity is vested. The term that we use, equity or share, is vested, which means that the payment of share is attached with some kind of conditions. Okay, vested. We say that vesting condition, vesting condition. So some type of vesting conditions. And when you recognize this kind of transactions, you have to check carefully what is the vesting condition is actually are. All right. So now let me give you two examples. What is vesting condition actually? So vesting condition is that an entity receives the services. Vesting conditions mainly again are related to employees. Again, I say that simply receive a service that entitle the counterparty to receive cash. Okay, so kind of a contract that an entity receives service and the counterparty will receive cash or other assets or equity instruments. So this equity instrument is now vested. That is what is meant. Depends on receiving goods or services. And the goods and services can be received immediately, so the equity instruments will be vested immediately. Okay, but if the goods or services are received in installments, or maybe the services in 2 years, over 2 years, over 3 years, then vesting condition continues over 2 or 3 years. So vesting condition mainly for either a service condition or a performance condition. For example, if we say that sick leave is vesting, okay, when the employee entitled to get cash, okay, settlement for unused leave. So sick leave is vested. But if the employee is not entitled to get cash for unused sick leave, the sick leave is not vested. Okay. So vested condition is something like that. A condition is attached. After fulfilling that condition, the equity is actually will be paid. The share actually will be issued. Okay, so let's take another example. Again, I said that the question asks that you provide journal entry, but will not be asking you to do journal entry because you're not accounting students. So the 8 directors of San Francisco each received an option at January 1, 21, 1st of January, 20x1. Is there a question? Okay, I heard some noise anyway. To take up $101 shares in San Francisco for purchase consideration of $30 per share after completion of 2-year service. So these directors, if they complete 2-year service, okay, San Francisco says that the nominal value of $1 share, they can take up to $100 shares, which will be valued $30 at the time in consideration. San Francisco obtained the services of valuation expert who calculated the fair value of the shares option provided to directors to be $15 on January 31, 21. Okay. Look at this very carefully, that this is a kind of a 2 years vesting condition. Okay. These directors, if they complete 2-year service, they'll receive 100 shares. Shares nominal price is $1. Okay. But the company is agreeing to pay $30 against each share. All right. But unfortunately, San Francisco obtained a valuer who valued their shares' current market price is $15. So directors, as per the standards, unfortunately, they have to accept these $15. All right, not this $30. Okay, so how this will be actually recognized, recorded, and reported in books of accounts. So the question asks, let's go back to question again. Question asks that journal entry to account for the transaction for the period ending December 31, 20x1. So asking you to provide journal entry at the end of first year, but the contract is for 2 years. Okay, so at the end of first year. So you'll only see the calculation at the end of first year. So at the end of the first year, there are 8 directors. Each will get 100 shares. Okay, and the fair value of share is $15. Okay, so total comes to something like $12,000. So they are recognizing at the end of the year. When they recognize this transaction at the end of the year, even at the end of the first year, they are calculating for the whole period of 2 years, remember. Okay, that is what the liability of the company. But because the question asking that how much you're going to record at the end of the first year, you're going to record half of the total payments, which comes to 6,000. Okay, it comes to 12,000, and at the end of the first year, half of it is 6,000. So in the second year, what this entity will do, they'll again appoint another valuer or the same valuer, and it will value the share in the second year. Okay, and suppose in the second year the value is $20. So what you'll do, 8 directors times 100, okay, times 20, you find out the total. From the total, you subtract 6,000 already paid, and the rest, what is not paid, will be recorded at the end of second year. Okay, so this debit credit is not important for you. You just check this calculation, how it is calculated. Okay, any questions so far from anybody? Should I proceed?
Yes, Professor. If they have a question, they will raise a hand and ask.
Oh, okay. All right. Thanks very much. All right.
Yeah.
So far, we have just dealt with the technical and overall theoretical aspects of the share-based payments. Now we'll move to more specific areas that if it is a equity settled share-based payments, which are mainly related to it goods and services transactions, okay? But cash settled share-based payments are mainly deals with service conditions. Okay, so how this will be valued, how it will be measured, the first thing, all right? So you are receiving goods as in consideration. You're receiving goods as a consideration, and you are going to issue shares. How you are going to measure how many shares to be issued? That is a question, okay? So what you need to do, you first measure the value of the goods or services that you have received. When you talk about value, the value is going to be fair value, okay? Now, suppose you are unable to measure the fair value of the goods and services that you have received. What are you going to do? Then what are you going to do? You're going to value the equity, the share, and then you pay that share. And again, that's going to be fair value. So first step, you measure the goods that you have received, the fair value of the goods, and you then issue equivalent shares, okay? Remember, again, share may be, when you record, part of may be equity, and if there is a premium to be recorded separately. And there is one type of shares which is not applicable to India anyway. It's called Black Economic Empowerment, BEE. I think it, the standard actually particularly mentioned about it because it only applies to South Africa, maybe South Africa following IFRS of SMEs, so they'll follow this one. We don't have to deal with that anyway. If you need to know more about it for your curiosity, give a Google search and find more about it. Okay, now if you are going to pay employees through equity settlement, equity-based share payment, okay, what are you going to do? How are you going to value service, which is very, very complicated, isn't it? Valuing service is going to be highly subjective, all right? So the standard saying that, okay, fine, the best thing is that you better check the fair value of your equity, and you then agree with the employee that on a particular date, whatever fair value of the equity will have, okay, and we'll then actually pay you, something like that. And when you calculate this fair value of shares for paying to employees, of course, you have to consider all market conditions, vesting conditions, non-vesting conditions, everything. All right, when you calculate the fair value of shares. Okay, so service conditions, of course, the condition may be that you serve for 2 years, and at the end of the 2 years, you'll get certain amount of equity shares from the company. Or if you perform, and once the milestone of your performance is completed, you will get some kind of equity shares. And there may be market and non-market performance conditions. The company can say that, okay, we'll get this kind of shares, this type of shares, provided that the market price of share goes up, something like that. So these things you need to consider while you are going to calculate the fair value of the share for service conditions. Okay, so this triangle, this hierarchy actually gives you some idea. So the condition says that when you receive service from an employee, it is difficult to measure the value of the service. Okay, if it is measured, that is the first priority. But if it is not easy to measure, then use the fair value of the share of your entity to decide how much you're going to pay to your employee. Okay, and to determine fair value of the equity, the most preferred method is to check the market price, observable market price of the share. But there is a limitation of that. Most of the SMEs shares are not traded in markets, so probably will not get market price of the share. So next preferred method is recent transactions. So if you have paid another employee or group of employees using shares of your entity, you can use as a precedence and use that one as a value to pay another employee. All right. If it is not available, then you can use valuation technique. So there are many recommended valuation techniques, and it is better that you actually appoint a certified valuer to avoid any future conflicts. All right. So certified valuer will value the shares and use that value to pay your employees on a particular date when they complete their performance or complete their service contract. So these just, I have just explained these things. I'm just skipping this slide. Okay. So first we discussed about the theoretical aspect, the conceptual aspects of the share-based payments. Then we just briefly discussed about equity-based payments against goods and services. Okay. Now, what happens when there's a cash settled payment? Okay. How are we going to measure it? How are we going to recognize it? Remember, though, these cash settled share-based payments are mainly dealing with payments to employees. Okay. Very rarely people will supply you goods and wait for 2 years to get the payment. No. So normally it deals with employees. And the difference between equity settled and cash settled, to refresh your memories again, equity settled is that you issue new shares and pay immediately just by issuing shares. But in a cash settled, first you determine how much cash to be paid. Okay. So once you lock into contract with an employee, you determine how cash to be paid, and then you just show that as a liability in your balance sheet, that cash to be paid payable. And if this cash to be paid after 2 years, based on a particular price of the share of the company, of the entity, okay, then in 2 years' time, use that price and pay the employee. Okay. But you may be asking me that, okay, we lock into contract today and say that today's share price is $10. So we'll be paying $10 to you. Okay. But in 2 years' time, share price may be $100. What are you going to do? All right. So standard says that if it is a 2-year contract or 3-year contract, you need to reassess your liability at the end of each year, and you record it and you show it in your balance sheet. You disclose it in your balance sheet. Okay. So at the end of first year, you find share prices be different. You record using that new price as your liability. At the end of second year, you say, see share price would be different. You use that price and show that as a liability at the end of second year. So liability needs to be assessed at the end of each year. So clear about this distinction. The first process is that you're going to pay equity share immediately. Your interest equity is going to be increased. In the second scenario, you are agreeing to pay cash after fulfilling some kind of performance requirements, okay? And the cash will be paid based on the share price at the end date of the contract, okay? Whatever the price of the share is in the market, or whatever the fair value that you determine if your share is not traded in the market, okay? But because you are going to pay at the end of second year or third year or fourth year, the standard says that each year you need to assess your liability and disclose that in your financial statement, the changed liability, okay? So let's take another example, okay? I think I'm not running out of time, I'm okay. All right. So stay with me. On January 1, 20X1, Casablanca grants a cash-settled share-based payment transaction to 100 employees. In terms of the transaction, each employee is entitled to receive the increase of the independent value of the 10 shares of Casablanca. Each employee received 10 shares of Casablanca, valued independently, above $20 in cash, after a vesting period of 2 years of service. See that? So this is a vesting condition. So it's a 2-year. At the end of the second year, company is going to settle just by paying cash. But prior to that, company is going to show it as a liability until unless they are paid cash and settled. Okay. On January 1, 20X1, it was expected that 90% of the employees will still be in service on the vesting date. The actual number of employees in service on December 31, at the end of the vesting period, 88. The independent expert valued the right attached to share as follows: December 31, $6, December 31, 20X2, $9. Okay. The full liability settled, of course, at the end of second year. So the question is asking, provide journal entries. Don't need to learn journal entries. Just calculate how much liability will be shown at the end of first year, how much liability to be shown at the end of second year. That is the thing that you need to learn. Okay. And there is not rocket science, pretty much standard. Okay. So at the end of first year, 20X1, how much liability is going to be shown? Each employee is going to get 10 shares of that. There are 100 employees, 90% will take this opportunity, okay? And the end of first year, shares right price is $6, okay? When you value at the end of the first year, remember you're valuing for the whole contract of 2 years. So to record in first year, you record half of the total contract as liability. So it says that share-based payment liability, 2,700, 2,700, okay? In the second year, again, the employment cost is 5,220 and the liability 5,220. How did they get it? In the second year, it said that 88 employees will take this opportunity. 10 shares will be given to each, okay? The value is going to be $9, okay? Then you get the total value of the contract. Of that, you have already paid $2,700. So the rest of the amount, a remainder of the amount, will be paid to the employees at the end of the second year, 5,220. Okay. Now the question is, so are these employees going to be paid only 5,220? No, they're going to pay 5,220 plus 2,770. So what will happen? There's a third journal entry. I'm just saying for your sake that third journal entry will be share-based payment liability debit and cash credit, which will be total 5,220 plus 2,700. Okay. So again, the final thing is that how we're going to disclose. There's a huge requirement. I'm not going each by each. They are self-explanatory. Just go by yourself, you'll understand. Like you need to disclose what type of share-based payments you have used. If you have used both, you need to disclose that you have used share-based payment and cash-settled payment. You need to disclose. Again, then you need to disclose how goods and services values were measured, how values of the liabilities for cash settled payment were measured. You need to disclose all of these things, all right? So that when they are disclosed, if you take 5 statement function reports of 5 different SMEs, you can compare because they're on the same boat. All right. And the last part of this lecture is, of course, the difference between IFRS for SMEs and full IFRS. Of course, the full, they require more things than the SMEs. And you just have a look at it and compare and see that. Remember, the standard says that if your business falls under large business as per definition, and if you use IFRS for SMEs, that will not be actually recognized. You'll be penalized. Be careful about it. Okay, at the end of the first part of the lecture, any questions?
Students, any doubts, any questions, you may please ask now so that Professor can move to the next topic.
If not, I said that if you're too
Yes.
shy, you can send by an email to Professor Charamati. I can respond.
Okay, Prof. We can.
Okay. Okay. The next topic is really, really important and crucial. All right. And this is one of my favorite topics. And I hope at the end of the lecture, it's going to be your favorite topic. All right. Impairment of assets. Okay. And I mean, accountants, since the standards been started, accountants been actually debating about it. The regulators are debating about it. And ultimately, they came out with solutions. And these solutions are now really applicable and acceptable by most of the businesses for SMEs and for large organizations. Okay. The main concept is that suppose they're looking at a balance sheet of a business, of an entity. Okay. Balance sheet. The balance sheet lists liabilities and assets and equity, right? Balance sheet. How the equity is calculated? If you get the total of the assets, and from there, if you subtract total liabilities, okay, the difference is actually equity, right? And when you get the value of the equity, the value of the equity, that is used to understand the worth of the business. Okay, so business X has got $1 million equity, and business Y, they're in the same industry and everything, has got $2 million equity. Of course, business B is more valuable, isn't it? Other things remaining the same. Okay, so remember, equity is calculated, total assets minus total liability is equity. All right. Now, suppose total assets, the asset, they're shown in the balance sheet. Okay, whatever shown in the balance sheet, they're not actually worth that much. It's possible, right? Whatever shown in the balance sheet, they're not worth that much. If that is the case, they're worth less. If that is the case, so if that thing is not taken into consideration in reporting, then the value of equity that you will be calculating will be misguiding, okay? And the decision that you'll be taking based on equity will be wrong decision, okay? So the concept is whatever value is shown of the assets in the business, okay, may not be worth same. They may be less, they may be more, okay? So when it is less, that is covered by this standard. When the value of the asset, what less, that is covered by this standard. So when the value is less, that is called impairment of asset. The asset is impaired. I'm coming to point in details very soon. Now you might be asking, when the value is more, what is going to happen? Standard is actually really quiet about it. All right. Standard do not give too much leeway to us to increase the value. All right. Because if we give that opportunity, all entities will start increasing the value of the asset in the balance sheet, and they'll show their high equity. And as a result, you'll be convinced to buy shares of that company. And at the end, you will become bankrupt. All right. But anyway, IFRS goals for the large organization got a standard on that. Okay. So, which is not covered in this unit, I guess, in this subject. If you're interested, you can have a look at that. In Australia, we can actually, we are allowed to increase the value of the asset. There are some terms and conditions, of course, for entities who are listed in Australian Stock Exchange. That's later thing. That might you learn later. Okay, so you understand the concept of the impairment of the assets. I mean, why you need that. So this section only covers for the assets which are property, plant, and equipment. Okay, intangible assets like goodwill, royalty, something like that. Investment in associates and investment in joint ventures. Okay, this standard doesn't deal with inventories, deferred tax assets, asset arising from employee benefit, financial assets, investment property, and biological assets. There are separate standards for it to deal with that. Okay, you might also be thinking that, well, I've heard about a term called depreciation. So when you depreciate an asset, isn't an impairment of asset? We're reducing the value. No, that is not. Depreciation means that you are allocating the cost of the asset over its useful life. If useful life is 10 years, if you're using kind of a straight line depreciation, you will divide the cost of the asset by 10, and then you deduct that depreciated value each year up to 10 years. But impairment is a sudden drop in the value of the asset. All right, for different regions. That is the impairment of asset. That is not depreciation. When you reduce the value of the asset in the books of account, then you need to depreciate the asset based on the new value again. So that is the difference between depreciation and impairment. Okay. So let's understand some definition. Impairment loss. What does it mean? Okay. Impairment loss is that if the carrying value of assets or of an asset of an entity is actually less than the carrying value exceeds more than its recoverable amount. Okay, so when you bought the asset, say paying $10,000 and recorded $10,000 in your books of account, which is the carrying value. But you now realize that if you are going to sell the asset now, you'll be only able to recover $8,000. So when the carrying value exceeds, okay, the recoverable amount, the difference is actually impairment loss. Okay, you need to record that, you need to disclose that, you need to measure that, you need to show as a loss in your profit and loss statement. Okay, otherwise equity will be showing inflated real equity, and decision makers will be misguided to take decisions on this entity. What is the recoverable amount? Recoverable amount is the higher of the fair value less cost to sell the asset, okay, or value in use. Okay, fair value, remember there are three conditions. Okay, knowledgeable person, they contract willingly, and arm's length transaction. Okay, and value in use is that you can calculate how much cash flow you are going to get in next 10 years from this asset. You discount them, okay, find your net present value, that is value in use. So you calculate both, and the higher one you will accept as the recoverable value. Cash generating unit is the smallest unit in a business, consists of group of assets that generate cash. So maybe production department, there may be 3 assets, okay? They use these 3 different types of assets to produce something. These three assets is a cash generating unit for production department. Fair value less cost sale, I said that what is fair value already, and I have explained what is value in use already. Okay. So impairment loss, I said that if the carrying value exceeds the recoverable value, there is a loss. All right. There is an impairment loss. And that loss to be recognized, that loss to be reported, that loss to be shown as a loss in the profit and loss statement. Standard is very, very specific and clear about it. All right. So what is the principle? The diagram shows that. What is the impairment amount? Okay. Okay, if the carrying amount exceeds recoverable amount, then there's the impairment loss. The recoverable amount may be fair value less cost of sales or value in use, higher of these two. Okay. And value in use may be asset of an independent business, independent asset, or asset from a cash generating unit. Okay. Now the question is when to impair an asset or when to impair a CGU, cash generating unit. All right. There must be some indicators of impairment. All right. So you don't just sit down saying that, okay, carrying value of the asset is 10,000. Who cares? I just sit down and all those things. All right. Don't do anything. Now, when you want to get your statement, financial statement audited, the auditor will actually find out that your assets were actually impaired and they'll not sign off. Or if they sign off, they will give a qualified audit report that that entity's assets are not worth as much as showing in the balance sheet. They are impaired. And if that is done, you are doomed. Okay? Nobody will trust you anymore. Nobody will believe you anymore, the users of financial statements. So each year, you need to use kind of an impairment indicator to identify that whether any particular asset needs to be impaired or whether a CGU needs to be impaired. Okay. So impairment indicators are actually, there are two types, external indicators and internal impairment indicators. All right. External means that you are selling you're manufacturing some particular product using a machine, an asset. All right. And you are okay. But some of your competitors, they came out with a different type of machine, which is just came new in the market. And they are selling more product than you at a lower cost, which means that the asset that you are using actually needs to be valued less. They're not worth because they're not going to generate that much of cash flows that used to be generated 5 years ago. One of the examples of external impairment indicators that now we think that your asset needs to be impaired. Okay. And there are other examples too. And there are internal indicators. For example, you might have changed some kind of your production policy. All right. We are using an asset to manufacturing a product. Then you suddenly decided that no, we are not going to manufacture this product 100% anymore, maybe 50% from next year, which means that this asset is not going to generate same amount of cash inflows in future, which means that this asset value will be less and the asset needs to be impaired. So these are the impairment test indicator that we use, and then we apply impairment to a particular asset or to a CGU, cash generating unit. You don't just sit down. You need to continuously monitor using impairment indicators. Okay, let's take an example. So an indicator exists when the carrying amount of a server may be impaired since the item will be replaced by new technology in 1 year's time. So you are in IT business, or maybe whatever business you're doing, you have got an asset called a server, okay, for your database or for your internet, something like that. And you know that this will be replaced with a new technology. So it shows that there's an indicator that server might be impaired. So when you think that server might be impaired, you need to calculate its fair value, at the same time its value in use. And you're going to accept higher of these two. So its value in use is actually calculated. And it's found that value in use is going to be more than its carrying amount. So one of the conditions is that if the carrying amount exceeds fair value or value in use, that is when asset will be impaired. But here, the value in use actually exceeds carrying amount. So there is no need to be impaired, okay? So this test says that the server doesn't need to be impaired, okay? Because value in use is cash inflow, is that will be generated over the next few years, will still be higher than the carrying value of the server. No need to impair the server. Okay, recovered amount, I have already discussed about it. That higher of the fair value or value in use. Normally, the standard suggests that you calculate both and take the higher one. But in certain situations, you don't need to calculate both. These are the two situations when you don't need to calculate both, okay? Suppose you calculate either fair value or value in use, and you find that one of them is higher than the carrying amount. So there is no need to calculate both of them, like the previous example, okay? Or if you find that value in use, all right? Value in use, even it is, say, lower than carrying amount of an asset, and you're thinking of impairing it, but you know that the asset is going to be sold next year. So you don't have to calculate fair value to find out which one is to accept, all right? So that is the way recoverable amount is actually calculated, okay? And when you calculate value in use, I said that you need to calculate cash inflows that will be generated by a particular asset in future. And this cash inflow needs to be discounted. I mean, present value needs to be calculated through discounting, okay? And that is what it's showing that how you're going to calculate value in use variables. You need to calculate present values of future cash inflows. Okay, so these are about, so far I have discussed about impairment of individual assets, and this is about impairment of cash generating unit. Remember, cash generating unit is the smallest unit in an entity involving two or more assets combining, and they generate cash inflows, okay? So a CGU contains two or more assets, all right? So the CGO will have a total value. Remember, itself has got a total value. Within that total value, there are two or more assets. These two or more assets actually generate the value of the CGU. Now, when you go for impairment test, you are going to impair the value of the CGU, the total value of the CGU. Now, when you reduce the value of the CGU, you need to reduce the value of the each assets that containing the CGU. All right? Understand? I repeat it again, the crucial point. Cash generating unit generates cash. Itself is an asset for an entity in total. But CGU has got multiple assets. All right? So when you impair the CGU in total. But when the value of the CGU goes down, then you also have to make adjustment of the assets that containing the CGU. That is the difference between impairing an individual asset and impairing a CGU. Okay, but others are almost same, that you use impairment indicator, you calculate fair value, you calculate value in use, you take the higher one, okay? And if the carrying value of the CGU exceeds the fair value or value in use, okay, then you're going to impair the CGU. It's exactly the same process. The only process that, only thing that you need to learn differently, that how you're going to make adjustment to the individual assets under a CGU. That's what we're going to see now. Okay, so these are the steps that I have mentioned. That you first identify the CGU, calculate the recoverable amount, calculate the amount of impairment loss, allocate the impairment loss to the assets. Okay, so this is step 4 is different from when you are impairing an individual asset. Okay, you need to allocate the impairment loss to individual assets. Okay, I'm just skipping this and let's take another example. That first example is about identifying a CGU. All right. So a company uses coal to create heat in its production process. It also mines the coal on the same property and owns a conveyor belt that transports the coal from the mine to the factory. Okay. The question is, should this mine and the factory to be treated separately as separate CGU or separate asset, or they should be combined and as another CGU? Okay, and to determine that, you need to find out that if this company treats mining separately, how much profit or loss is going to make. If this, provided that mine has got external market. If this business is going to create heat using coal in the factory, how much profit or loss is going to earn, provided that it can either use the coal from its own mine or you can buy coal from outside. Okay, you combine these two profits and loss, calculating separately, treating them as independent unit. Then you calculate profit and loss when you use them as a joint one, that the business is using or buying coals from its own mine and producing heat and all those things. If the combined profit is higher than when you treat them separately, okay, then this one should be treated as a CGU, both together. Okay, now if you want to impair, you impair this CGU, and if there is a loss, the loss will then be allocated to the factory and to the mining. So that is the first question. Okay, then recoverable amount is the same way. That is what I do for independent assets. All right, that is recoverable amount minus carrying amount of asset is actually impairment loss. It's the same, we already discussed. And then after we calculate impairment loss, we need to allocate this loss to individual assets in a CGU. Okay. So this is the example. That is going to be the most crucial example today, kind of most challenging example today. Okay. So look at this. The following information is provided for impairment of a CGU as a reporting date. So this CGU has got these 3 assets inside the CGU: goodwill, machinery 20,000, computer equipment 4,000. They are the carrying value. I mean, when they bought goodwill, probably they recorded 10,000. When they bought machinery, is recorded 20,000. When they bought computer equipment, 4,000. Okay. They have calculated fair value for machinery 14,000. Goodwill has got no fair value at this moment, 0, which means that carrying amount exceeding by full. Computer equipment has got fair value 3,500. And most likely fair value is higher than the value in use. So that is what they use to calculate impairment loss. That is used as a recoverable amount. Based on a discounted cash flow method, the recoverable amount of the CGU is determined to be 18,000. All right. So look at that. Their fair value 17,500 and value in use is 18,000. So higher of the two is 18,000, and that will be now used for recoverable amount. But their carrying value is 34,000. which indicates that CGU needs to be impaired. Okay, if you still show 34,000 in the balance sheet of this company, you are going to misguide the users of these CGU's financial statement. Okay, so there is an impairment loss. 34,000 minus 18,000. How much it is? Impairment loss is 16,000. Okay, so they are now going to record the CGU's asset value 18,000. All right, and they're going to show the 16,000 loss in the profit and loss statement. But at the same time, this 16,000 loss needs to be allocated. All right, so that we can see the new values after impairment. So the process is that goodwill has got no fair value at all. So of that 16,000, you allocate 10,000 to goodwill first, and goodwill is gone from the books. Okay, what is left is $6,000. Now that $6,000 is going to be allocated to machinery and computer equipment in the ratio of 20,000 to 4,000. Okay, when you calculate this ratio, that 6,000, they will find that 5,000 to be allocated to machineries and 1,000 to be allocated to computer equipment. Now, if you allocate 1,000 to computer equipment carrying value goes down to 3,000. But you calculated its fair value 3,500. So you cannot show that 3,000 in your books of account. It has to be shown 3,500. Okay, so you only allocate 500 to computer equipment, to make it 3,500, and 5,500 to machineries, and then reduce the value, which is shown here. Okay, that now goodwill is 0, nothing. Machinery's value is 14,500, and computer equipment's value is 3,500. Total comes to 18,000. The value after impairment tests were done. Okay. The next topic is depreciation. I said that once you impair the asset, you record new value of the asset or reduced value of the asset. You then depreciate based on that new value, not based on the carrying value. That was the old value. Okay. Next thing is reversal, which is a bit critical. Many companies that are interested, many businesses are interested because it shows a little bit better position than they actually were expecting. So reversal is that you impaired an asset already. Okay. Now, when you are going to do another impairment test on that asset, we found that its carrying value is actually less than its fair value or recoverable amount, simply. Carrying value, normal and carrying value exceeds recoverable amount, we go for impairment. You did the impairment. Now find that carrying value is actually less than the recoverable amount. Okay, which means that you need to increase the value of the asset. It's going to be impairment gain. All right, and the gain should be shown as income in your income statement. All right, so that is called reversal of impairment. Now you reverse the impairment. So how are we going to do it? Let's take this as an example. 2 years ago, an asset was impaired. Okay, the current carrying value of the asset is $15,000. If the asset was not impaired, the current carrying value would be $18,000. All right, you see that? Asset is impaired 15,000. Now today they found that it should have been 18,000. Anyway, an indicator exists that the reasons for the impairment have reversed. Okay, the new recoverable amount is $20,000. Okay, so they impaired 2 years ago to 15,000. If they didn't impair it, the asset should have been 18,000. I mean, that was the carrying value at that time. Today, when they did an impairment test, they found that recoverable amount is $20,000. Okay, Now, as an owner of an entity, of course, you want to show a better position of your balance sheet, better value of asset and equity, isn't it? So if I ask you a question that, are you going to use this $18,000 for reversing the value of the asset, or this $20,000 for reversing the value of the asset? Okay. Of course, you'll jump into this 20,000. That will increase the equity, isn't it? Unfortunately, the standard is saying that no, it cannot reverse to 20,000, even it is a current carrying cost, carrying value of the asset. Okay. You only can reverse up to the point to its original carrying value, which is 18,000. Okay. So you are going to increase the value of the asset by 18,000. There is a gain of $3,000, and that $3,000 is going to be shown in the profit and loss statement. Okay. So that is known reversal of individual assets. Remember, whenever you do these valuations, don't do it by yourself unless you're an expert, I mean certified expert. Okay. Otherwise, auditor is not going to accept this value. So the best thing is that you always employ a certified valuer for valuing these assets. Okay. And that will reduce of risk of getting a qualified audit report. Okay. Similarly, a CGU impairment may be reversed. Okay. Exactly follow the same thing. If you find that its current carrying amount is higher than the recoverable amount, okay, so you go for reversal. And when you go for reversal, you of course reverse up to the amount of the carrying value which was impaired originally, not the new value. Okay, same like individual asset. The only difference that after you increase the value of the CGU's asset, the increased amount now needs to be allocated. The gain needs to be allocated to individual assets. Okay, and the same process, the way we have learned how we allocate the impairment loss, here is the same way. You are going to allocate the impairment gain in the ratio of the assets the same way. All right. And then you show the new value of the individual assets and the total new value of the CGU. Okay. So there is another exercise on that. I am leaving that. I think I haven't used that anyway. I did not want to make it complicated for you. Now, of course, you go for disclosure requirements as prescribed in the standard, that you actually give as much as details in your disclosure, okay? Mainly in the footnotes of your financial statement, that how impairment losses were recognized, okay? Who is the valuer? Is it a certified valuer or not? If reversal was done, how reversal was done, who was the valuer, and all those things. So you give details so the user can get confidence in a financial statement, the auditor get confidence in a financial statement. Again, there are differences between full IFRS and IFRS for SMEs. Okay, so for example, for full IFRS, if there's an intangible asset like goodwill, they're required to use impairment test every year, irrespective of whatever happens. But for SMEs, you only go for impairment test if you think that there is a need for impairment. There is an indicator, okay? And there are other differences too. See, so that's why I said that this topic is really my favorite because you are dealing with showing equity of your business. You do not want to misguide your users. At the same time, you do not want to be penalized by misguiding. You have to be very careful in doing impairment of asset, at the same time reversing impairments. So that's about lecture topic 2. Any questions so far? Anybody?
So Monir, this was the case study I asked last year, the end semester examination.
So you're not going to ask this year, right?
Yes.
Okay. Well, okay. I think I feel happy.
Yeah,
if
this
you
was a
a
very
case study.
important topic.
It is indeed. If you use another case study this year, a different one, that would be okay, I guess. But it's up to you.
Yes.
Okay, for our last topic today is very quick. There's no calculation, nothing else. It's about employee benefits. How you're going to measure, how you're going to recognize, how you're going to report. Okay? I said that out of the three topics, the first one, share-based payment and employee benefits, are not too much crucial for SMEs because they normally don't exist. SMEs don't have too many employees, they don't give too many benefits anyway. So anyway, we'll just learn how they reported, how they recognized. Our main learning matter today is that we need to just understand what are different types of benefits paid to the employees. Okay, these benefits are of course cost to the entity, so they'll be shown as expense when they're expensed, and if they are not paid but will be payable after 2 or 3 years, they'll be shown as a liability. All right, and this liability is crucial though. All right, for example, in our university at this moment, the universal liability for the leave of the staff is multi-million dollar, and that is shown in the balance sheet, remember. So university from time to time forces us to take leave so that liability actually is reduced. All right, you do not want to increase your liability and then at the same time decrease your equity. So that's why you need to know the different types of employee benefits, how to recognize and how to pay and all those kind of things, okay? But the standard is unfortunately is not very much detail about it. Most of the cases you can use your own discretion, how to report, how to recognize, how to measure, all right? One thing is though that if you adopt a particular measurement criteria, some measurement criteria, some recognition criteria, some reporting criteria, okay? You must follow this consistently over the years, 5 years or 10 years. You do not make changes every year so that your financial statement looks better, all right? Auditors will then give a qualified report that this company is frequently changing its policy, which is not good, okay? So there are 4 types of employee benefits, okay? Short-term employee benefits paid within 12 months, okay? Post-employment benefits, so you retired, then there are benefits paid. Termination benefits, unfortunately, many employees are terminated, maybe because of poor performance or sometimes maybe COVID-19 related situation, no business, and they are terminated. So company pays benefit, redundancy payments, we call it. And other long-term benefits, okay? So if an employee works for 10 years or 15 years, they generate some kind of lot of other benefits. So main thing is that all these benefits, when they're paid, they will be shown as an expense and cash or bank account will be reduced, okay? If it is shown as an expense, of course, profit will be reduced, right? You might feel bad, but unfortunately, you have to do that, all right? Now, if they're not paid, for example, long-term benefits, which will be paid at the end of 10th year, all right? What does it mean? Are not you going to show anything in your books of account? No, you have to record. This benefit accumulates each year, okay? At the end of 10th year, there is a final amount, and that is when you pay. But it accumulates every year. And whenever it accumulates, you have to show this as a liability, as a payable, okay? To be recorded. And when you show as a liability, of course, your equity will go down. Unfortunately, that is the case, but you cannot help. That is need to be measured, recorded, and reported, okay? So that is about employee benefit. I've given all these examples. I'm not going by that, okay? You just read yourself and you will, of course, understand Only thing is that I said that they are expense item. Okay, they'll be shown as an expense. Okay, when they're paid. If not paid, if they accumulate, you need to record them as a liability, as a payable. Okay, let's take one final example. Tunisia has incurred employment cost amounting to $4 million. Okay, for the year ending December 31, 20X1. At the beginning of the same year, a housing scheme for the benefit of company employees was established. The terms of the housing scheme states that Tunisia is obliged to pay 10% employee cost as a contribution to the housing scheme on behalf of the employee. Very good employer. Normally, you don't see this type of employers anymore. Okay, contributing to the employees' housing scheme. Corporate social responsibility is very good. Tunisia had paid in amount of $500,000 in December 31, 20X1. Okay, so describe the accounting treatment. All right, so I do not want you to record the journal entries, you just calculate. See that Tunisia paid $500,000, but 10% of 4 million comes to 400,000, isn't it? So what Tunisia did, paid more than the required 10% for the housing scheme at the end of December 31, 20X1. Did you get my point? Supposed to pay 4 million, but 400,000, but paid 500,000 at the end of 20X1. So what are we going to do? Of course, that 400,000 is going to be expensed at the end of the 20X1. It is an expense item, employee benefit, paid. So it's an expense. Okay, it's going to decrease the profit of the company. And this 100,000 Tunisia paid additional, which will be adjusted against a future payment. So in next year, Tunisia is going to pay another 400,000. Then Tunisia will pay 100,000 less. Okay, cash, because it's already paid 100,000 this year, additional, which will be adjusted and it will pay cash next year only 300,000. So how this 100,000 will be shown in the books of account? There is a payment in advance, which is an asset for the company. So it will be shown as an asset in the balance sheet, payment in advance, because it will not to be paid next year. Okay, so 400,000 to be expensed in the same year, 20X1, and the same year, another 1,000 will be shown as advance payment, which will be shown as an asset, not as an expense. Okay, so that is the way you are going to differentiate between cash payment immediately, accumulating liability, which will be paid at the end of the 10th year, or if something paid in advance, how that will be treated, okay, under this standard. So that's about employee benefits. And of course, there are differences between IFRS for SMEs and full IFRS. You go through it. But the main thing is that the standard is not very much detailed about how we're going to treat employee benefits in accounting records. Mainly, we follow generally accepted accounting principles for which you call GAAP for treating employee benefits. Okay, I'm right on time. That's all for today. Now we have got about 9 minutes for question and answers, if you have got any.
Thank you, Professor Monir, for a very wonderful lecture. Actually, everything is very clear to the students, and so that shows your mastery over the subject. You are giving a very lucid style, and I think they have understood. The students, if you have any questions to ask, please ask, or any clarification or any kind of explanation. So amidst this pandemic, actually you made this 2 lectures possible, Professor, with all your busy engagements. And I thank you so much for sparing your valuable time And during this festive time as well as this pandemic time, you have made it to deliver these 2 lectures. Students, please, any interactions you like to have with Professor Monir, please have.
I said that I know students from that part of the world very shy. Even in my class here, South Asian students rarely ask any questions. But once I come back to my office, they follow me and they start all sort of questions alone in my office. So if you have got any questions, please email to Professor Charumati and I will be happy to respond to you.
In Lakmika's class, he made everyone to speak something. He was pressurizing and they started talking little bit. I think now they are very silent again.
Okay, I didn't know that, but I'm a believer of human.
The explanations are very, very clear, Professor. So maybe they will have some advanced thinking to advance the knowledge. So any queries, you must send the email to me. I will get it done through Professor Monir. Students, if there are no more questions, then we can conclude this session. Students, please respond anyone.
Yes, ma'am. Yeah. We can conclude this session.
Shyam, yeah.
Okay.
Okay.
All right. Thank you, Professor Charumati.
Yes, yes.
In Australia, we do not force students to speak up in the class, which is kind of violation against human rights. So I didn't do that, but that's okay. I know you are all brilliant students and you'll be all right.
Thank you, Professor. And we have also uploaded the assignment given by you, and I will take care of the valuation in the Google Classroom.
Okay.
Last class, you have given one assignment that is uploaded. And as part of the project, we have completed all the 10 lectures what we have planned. So thank you so much for supporting the project, and we will take up the other deliverables in the coming weeks. Thank you so much, Professor. Thank you.
Okay, so we can exit now, right?
Yes.
Okay.
Yes.
Bye, everybody. Best of luck.
Thank you.
Thank you, sir.